What's going on, y'all? I'm out here with Rob from Click Mortgage. We're gonna drop some mortgage tips for future first-time home buyers. Let's get right into it. So, Rob, how or what does it take to qualify someone for a loan in 2023?
Qualifying is as simple as really two things. You got to have income, whether it's your business or you have a job, and you got to have credit. We have programs that go as low as a 580 credit score. If you have those two things, it's time to talk to a lender and talk about your options and see what else you can do.
Awesome. Rob, what happens if I have someone come to me, they're a client, they're undocumented? Can you work with that?
We do. We have some programs. They're called ITIN programs. As long as
Okay.
someone has a tax ID number and they file taxes, basically they have income that's reported as taxable income, then we have programs for them. We can go as low as 10% down for those programs.
Okay, understood. So how do you, Rob, get paid as a lender?
Lenders, we're paid similar to real estate agents, but a little differently. So whereas the selling agent or the seller may pay a commission to the real estate agents, lenders, we originate loans which collect interest.
Yeah.
That future interest on that loan that you're going to pay covers our commission. So you actually don't pay it directly. It's our investor pays us for creating a loan that they're going to get paid back on in the future.
Okay, so the interest, the interest is actually what gets you paid.
Yep. The interest that they pay covers our cost of doing business.
Does that get affected when you do a zero down program?
It's all similar. It's all the same, and there's a few different ways it's structured. But a zero down program is really more similar to regular programs than different. All it allows you to do, a normal program, usually you put between 3 and 20% down payment.
Yeah.
A zero down program gets you an additional loan or a grant or some other way to cover that down payment. So your down payment is effectively zero. The only thing we worry about is closing costs, and right now in the market, a lot of times sellers are paying those closing
they're
costs.
getting covered.
It truly can be zero out of pocket in many situations for buyers.
So what you're saying is when the closing costs are covered, which we're seeing a lot of in the current market we're in, you can actually go zero out of pocket.
Practically zero out of
process?
pocket. I mean, you might need to pay for an appraisal, although a lot of times I'll pay for appraisals for clients. They might need $1,000 or so just to get that earnest money deposit, that initial upfront money into escrow. Other than that, it's virtually zero out of. I never say zero, but it's pretty darn close.
It's pretty close, right? In
Yeah.
the current market we're in, and this is not going to last for long, right?
And we saw, the big question is about rates and changing. And a few years ago, we knew rates were in the 2%.
Yeah.
That was great for payments, but prices shot up, so you still have a higher payment. And sellers didn't have to give closing cost credit. So buyers were coming out of pocket $10, $20, $30, $40,000.
Yeah.
Whereas now rates are higher, but you can come out of pocket with less money. Home prices even fallen a little bit, or not being sold over list price. So right now it's almost easier to buy a home, despite the misconception that higher rates make it harder to buy.
Understood that. So talk to me about some of your zero down programs.
Zero down programs. We have two main ones, and both of them allow you to use what's called an FHA loan. Normally has 3.5% down. There are two variants. One of them is for first-time buyers that allows you to get a second mortgage. We cover all of that, so we get a second loan that covers their down payment. So there's a zero down payment, and that one comes with the closing cost assistance loan.
Wow.
That's great. That one requires a 640 credit score, and you have to be a first-time buyer and make under the income limit. It's between between $100,000 and $80,000 now. It went up actually a while ago. The other program has no limits, no first-time buyer requirement, a lower credit score requirement. Same thing. We get an additional loan for that down payment. The difference is you pay a little bit more because you actually pay that loan back over a 10-year period.
Okay. So a lot of the time when I'm talking to buyers, they're concerned with if they go zero down, it's going to affect their month-to-month payment. Is there any trueness to this?
Yeah, and it's true. It will affect their payment a little bit. Nothing's free in this world, as I say, and there's no magic in mortgage. It's all math. And when you have a down payment assistance program, you're going to have a little higher interest rate. Couple that with you may save the $10,000 to $20,000 that you would have paid out of pocket. Now you're putting zero or close to zero out of pocket. So yeah, you're going to pay a little higher monthly payment. However, what a lot of people can do, they'll have a higher interest rate when they get that mortgage. 1, 2, 3 years down the road, they can usually refinance that maybe into a conventional loan that has a little better financing or payment terms. Maybe rates can go down. I think it's likely. We don't know for sure, but it's really common to see people refinance out of that assistance loan into a conventional loan. They get the equity. They didn't put anything down. They get the best of both worlds by using a program built to help them out.
Okay, yeah, that sounds awesome. So I think there's a lot of misconception around how many FHAs you can get. Could you break that down a little bit for us?
You can get as many as you want over your lifetime. You can only have one at a time unless you're relocating because of a work change or some kind of extenuating circumstance that would warrant it. The common guidance on this, if you're moving 100 miles away for a work transfer or a family-related thing, you can actually get a second FHA loan without paying off your first. Maybe turn that existing loan, if you have a house, into a rental
property. So
property.
while the first FHA is ongoing, you move away for work, now you open up another one for that new location.
Yep, has to get approved by FHA, but most of the time they do, and I've had a lot of good success with that.
Okay, so yeah, there you have it. You can not only get one FHA in your life. Remember that. Tell that to all your friends who think they're realtors. All right. So how often do you run into clients that are undocumented, like we had talked about earlier?
It happens. It's not as common as a documented worker, but it does happen, and it happened enough where we made sure we had a program to help those people out.
Okay. So it's something that you kind of deal with here and there.
Oh yeah, yeah. It's common enough.
Okay.
Yeah, it's not a rare case, and it's very. We know how to handle it. A lot of lenders do, a lot of agents, and it's just a normal part of doing business, helping people buy homes.
Okay. So like you had mentioned earlier, we had 2% interest rates less than like 5 years ago, and now we're touching almost 7%. What is the difference in getting a loan between those two interest rates?
The main difference is how much are you going to pay per month. That also means there's less competition. When we had rates in the 2.5% to 3%, it was a buyer's frenzy, total seller's market, meaning there's less homes than people who want to get them, and they're bidding $10, $20, $30, $40, $50,000 over listing price, waiving contingencies, not giving them proper time to do the proper inspection. So it was a stressful time to be a buyer.
Yeah.
I would actually rather buy right now for a couple of reasons. Prices have kind of come off those crazy highs. Now you have time to think about it, do your inspections. Sellers are trying to incentivize buyers to buy homes. We're seeing a lot of closing cost credits. They're even giving credits to buy down someone's interest rate. That's a key that not a lot of people talk about, is a seller can actually pay to lower your interest rate either temporarily in what's called a 2-1 buy down, where we buy the rate down a lot in the first year, a little the second year, and then it goes full in the third year, or a permanent buy down which lasts for the entire 30 years of the loan.
What's the difference in price between a 2-to-1 buy down or a permanent buy down?
The 2-to-1's going to cost a little more, but it's going to lower their payment in the long run. And to figure that out is I have a calculator that I run through with everybody and show them, here's option A, option B, the 2-1 versus the permanent buy down. And we do the math and figure out what's your plan, how long will you be there, what makes the most sense.
Awesome. Cool. What is the best loan for first-time home buyers?
It's going to depend on two main things: what your credit score is and how much down payment you have. General rule of thumb, if your credit score is under 680, FHA is the way to go, unless you're in a rural area where USDA can be used. That's places like Roseman, Lake LA, Lake Elizabeth, something outside of a city. It's a zero down program.
Okay.
That's really favorable. But for the average first-time buyer with a credit score under 680, FHA, 3.5% down is the way to go. Can be used zero down with the down payment assistance. If your credit's over 680, 700, conventional loans can go as low as 3% down, a little bit cheaper in certain aspects. So that's part of the process. What I do is figure out what makes most sense for them based on the things I know about their situation.
So as a lender, would you say that you kind of serve a role as a financial advisor for your clients as well?
In a lot of ways, financial advisor is a good way to describe it. It's mortgage advisor is a good way to describe it. We want to figure out how much can you afford. We don't want to put someone into a house they can't afford.
Yeah, definitely.
Now or down the road. Prep them for down the road expenses. How much will it actually cost them? A lot of people don't even know what closing costs are or how much they're going to be. So it's my job to make sure someone is comfortable and understands what they're doing before they sign on that dotted line.
So just to touch on what you had just said about a lot of people really don't know what the closing costs are and about the cost throughout the whole process of buying a home. So could you break down, say we had a zero down program, so we're coming with zero out of pocket, what costs should we then think to run into going through the process?
The simple calculation is closing costs end up being around 3%.
Okay.
That includes everything from the escrow fee. We have our own lender fees. There's an appraisal. There are you're going to set aside money for your property taxes, your first year insurance. A lot of things go on that list, and every buyer gets a list of all the closing costs.
Yeah.
It turns into about 3%, and that's where we talk to them about their budget, and we can talk about the seller contributing to maybe lower that cost for them, which again, most people are doing that right now.
Okay. So you kind of talked about how you have, your own price points as a lender and what you charge people throughout the process. Is there any way to tell if a lender is a red flag?
Red flags are paying anything up front. If a lender's charging you money before you find a house, that's a definite red flag. No application fees, no credit report fees. For us, they don't pay a single thing until they find a home and they order their appraisal, which we actually don't even charge the appraisal. Our appraisal company is what's getting paid, and we just collect the money. We're more of a processing partner for them.
Okay.
But yeah, no fees up front. Some big banks or credit unions do that, and I don't think it's a good idea because it can lock them into a lender, and maybe they get a weekend and realize it's not a good fit, but they're stuck because they put $500 down. They don't want to lose that money. For us, we want our quality to stand for ourselves. So if they're not happy with us, I want them to find someone who's better for the situation.
Yeah, that makes sense to me. So anything upfront paying it doesn't make sense for if you're communicating with the lender, right?
Yeah. So red flags, I'll give you a couple of them. So no fees up front. You should have your lender's direct cell phone, and they should respond quickly.
Okay.
I have my cell phone number goes to every single client. We get pre-approvals done in a day or two, and when we're in escrow, people can reach me by text or email every part of the day.
And you're a busy guy too. It's not even like it's super easy for you to talk to every single person very quickly.
It takes time, but I know how I like to be treated, and that's what I strive to do is give people what I expect.
So that's something that you should look for in a lender as like a number one priority, right?
Yep.
To make sure that they're communicating with you.
Communication, transparency, responsiveness, trust.
You heard the man. So, what is the difference between a refinance and pulling a HELOC out? This is
Yeah.
for my more advanced. This is for my investing side.
Refinance versus a HELOC. When you do a refinance, you're getting a new mortgage and you're paying off the existing loan. You're replacing whatever loan you had in place. That means if you had a lower interest rate or a higher interest rate, you're replacing that loan with whatever the current market rates are.
Okay.
That makes a lot of sense when rates go from 6% down to 3%. You want to pay off that 6% loan, replace it with a 3% loan.
Okay.
Right now, the opposite's happened. Rates went from 3% more in the 6% range. You don't want to refinance that and get rid of that 3% to get a 6%, but you might be sitting on a lot of equity, especially if you bought your home a few years ago.
Yeah.
That's where a HELOC or a home equity line of credit comes in. That's a second mortgage where you keep the first in place and you just take a small second loan at it's market rate, sometimes a little bit higher, but it allows you to pull some money out, some of your equity out to use for whatever you want to do
Okay.
without messing with your first loan.
So say I had bought a home in 2021, 2% interest rate. I built up a little equity in my home. Should I refinance or should I pull a HELOC if my end goal is to invest in another property?
Most people are going to be better suited to pull a HELOC, especially if they want to buy a vacation rental, buy a vacation home, an investment property. Maybe they want to just keep this current one as a rental and go move into a bigger house somewhere else.
Yeah.
Pull that HELOC to grab that equity. And the big key is pull the money while you're in the house. If you live in a home, you get more favorable terms on whatever financing you're getting.
Okay. I have one more. I kind of want to talk about HELOCs for a little bit longer if you're cool with
How much
that.
you want, man?
Yeah, because I know people are very confused about the refinancing thing.
Mhm.
So, all right, we'll go back to it right now. So, why do people always pitch to clients and buyers and people in the market, buy now, refinance later? What do they mean by that?
The common thought right now is that rates are high and they're going to come down, which is really nice thing to say. And I think there's a good chance that'll happen. What people are saying to do is rates are high and there's a good chance that we're going to see low rates again. Therefore, just buy a house now. Don't worry about the higher rate. And in the future, when rates fall, refinance that. Now, I don't tell people that that's going to happen because we don't know for sure what's going to happen. So whenever I'm talking to someone or advising them on a mortgage, I make sure they can afford whatever mortgage they're getting.
Yeah.
It is possible that we may see rates go down over the next few years, 5%, 4%, maybe even 3% again. That'll allow them to refinance and lower their mortgage payment. However, if they had waited to buy and they waited for that lower rate to come, there's a good chance when rates fall, that means the payment for that same priced home is going to also fall, which means buyers can afford more. More people enter the marketplace and they bid up the price of homes. So if they wait, maybe that $400,000 house at 6% becomes a $450,000 house at 4% because people can afford to spend more money. So it's almost better to buy that house at the higher interest rate, maybe the lower price, and then if rates go down, refinance it at the lower price. Now you're getting the benefit of lower price with that lower interest rate, and overall that's going to be better for their financial situation, especially when we're talking 10, 20, 30 years down the road.
Okay. So what are what are the different types of refinancing?
There's three main types. You've got your rate and term refinance, meaning you're just getting a new loan, not taking cash out, ideally to benefit either the rate to be lower or the term to be a shorter term if you want to pay it off sooner.
Okay.
Then there's a cash out refinance where it's similar to the rate and term. You're still getting a new rate or term if you want it, but you're also increasing your loan balance to pull some of that equity out.
Okay.
Those are your loans where you're replacing the existing loan. In a separate category is your home equity line of credit or a second mortgage, which is similar but different, where that first mortgage, that original mortgage stays in place, but you take a second mortgage. It's always to pull out equity because if you're adding a loan, you're going to get equity. But the HELOC, the home equity line of credit, that's something where you can charge it up and pay it down, kind of like a credit card, so you can tap in and out of equity for home improvements, pay it off. Or we also have a program, a second fixed rate loan or a closed end second mortgage, where they get a second loan and it's paid back over a fixed period of time. usually 10 or 15 years. You can't charge it up and down as you want to, but usually you get a better interest rate to do that because you're predefining your term to pay it off.
And when would you say is a bad time for someone to pull a HELOC? Or like, what is a situation to be in where you wouldn't want to pull a HELOC, or maybe you would want to refinance?
Yeah, so a HELOC might be risky if, well, one, if you're not comfortable with the payment and if you're using that money for maybe a risky investment. I would say everything that someone should do, they should be able to know they can afford to do it. The other risk is by pulling out a HELOC, you're increasing the amount of debt on your house. If there's reason to believe that the home prices might fall, you may run into a situation where your equity shrinks and it's possible that your home could be worth less than all the loans you have. Now, if you can afford the payment in the long run, that's okay. People who bought homes in 2005, 6, and 7, at this point now they're way above where they started at. But for a while they were underwater. So it's good to be aware of the risks of if you take out too much debt, your home could be worth less than what you borrowed. But if you can afford the payment, long term, it's not a bad deal.
So in the case that your home actually loses value and you've already pulled the HELOC, and what do?
Just keep paying the payment. There's no recourse. The only thing you can't do is sell.
Yeah.
Well, if you try to sell, then you're going to owe money because the home can't pay off the debt. So it just makes it means you're stuck in the home that you're in if you wanted to sell and you didn't have savings.
Okay. So kind of just want to give the audience a ballpark of like how much they would need to come out of pocket to buy a house. So let's keep the math simple. Say we're in the Antelope Valley. I think our average home price is about $450,000 here. With a $450,000 house, what would a payment look like from coming out of pocket for your down payment to your monthly payment? What would that all look like?
Yeah, so $450,000. Someone who's got average credit and kind of your middle tier buyer, they're probably expecting a payment in the ballpark of $3,000 to $3,500 a month.
Okay.
The out of pocket, well, if they go an FHA loan, they're looking at 3.5% down. That's about $16,000 for quick math. Down payment, that's the part they have to cover themselves from a gift from family or a close friend, or they can use down payment assistance.
Yeah.
Those are your only options to pay for the down payment. The closing cost, another 3%, approximately $12,000. That's the one that can be paid for by the sellers. We have lender credits we can help with. There's a lot of people that could contribute to that one that couldn't contribute to the down payment. All in all, if you add those together, 16 plus 12 is about 28,000, 30,000 for rough numbers. Okay. You'll pay for a home inspection, pay for appraisal. So 30,000 on the high end, 16,000 if the seller pays everything, or even lower if we use a down payment assistance program.
So those numbers 1,000% are going to scare people, and this is why I want to insinuate that right now is like one of the most insane times we have for buyers. We're in a buyer's market. Would you agree?
We are, finally.
It's so easy to go zero down, have closing costs covered, get points to get your interest rate brought down. So right now, I hate to tell people what to do, but if you're out there and you're on the line of, I'm not sure if I want to wait or not, yeah, the prices may come down a little bit more than they already have, but when it comes to the programs that are offered to you right now, we probably won't see that again for how long?
The down payment assistance programs existed. They've always existed. No one was accepting those offers because they're just not as attractive as a 20% down conventional. So that zero down buyer, that assistance buyer, couldn't even compete in 2020 and 2021. But now they can because sellers don't have 10 offers being thrown at them on the first weekend.
Yeah. Okay, yeah, that makes sense. So to kind of go off track from where we're at a little bit right now, should people take state taxes like housing taxes into consideration when buying a home?
So like property taxes?
Yeah.
Yeah, and that's part of what we do is a mortgage payment covers 4 things. The loan payment, that's your principal and interest, your property taxes, your homeowner's insurance, and if they put less than 20% down, their mortgage insurance or their PMI. We build all those things into one payment so they don't have to worry about it. Every month when they make their payment, their property taxes and their insurance gets set aside in a separate account called an escrow account or an impound account. Same thing, 2 different terms for it. And every year or every twice a year for taxes, that money is used to pay their property taxes and insurance. It's my job as a lender to properly calculate, to my best guess, what their property taxes are going to be. In California, it's a little tricky to do it. I've got it pretty dialed in. So yes, they have to consider it, but I do that for them and show them what they're going to pay altogether so they don't have to worry about it.
Okay. And so one last question as we close out here. Say we had a client in front of us right now. They were ready to buy. They had everything ready. They had a stable income that can, afford them that $450,000 house that we talked about. But they were scared of the closing / down payment / whole process and the payments that would come on top of the month to month. What would you say to them?
I would say that have a good look at your finances. If you've got a partner or a spouse, talk to them and really figure out where you two are comfortable with. Nothing worse than jumping into something that you're not comfortable with, and then being forced to sell, or if worst case, lose the home, which we don't see that very often now because people do have equity. But I say talk to your people and really don't make a rash decision. And when you've really decided that that's what you want to do, then talk to yourself, talk to myself, talk to the professionals that can guide you through and make that process as easy and seamless as possible.
Cool. Well, thanks for your time,
Yeah,
Rob.
man, great time.
This is Rob with Click Mortgage. For all your mortgage needs, make sure you tap in with him and his company, Click Mortgage. All right, y'all.